All right, today I'm going to do a quick discussion of stock buybacks and why, in certain circumstances, companies are stupid not to do a buyback. And remember, there's a whole bunch of ideological debates going on about buybacks right now in kind of our political environment. And I want to set that aside for now. I want to actually go through the mechanics of an example because I think it's sort of illustrative for kind of intermediate level investors to kind of think through why it needs to be done under certain circumstances. So for this example, let's just imagine that there's a company with a market capitalization of $10 billion. And it's, in other words, the share price times the number of shares in total is 10 billion. And let's say it's a debt-free company. And let's say it's a very well-run company that generates a lot of cash over time. And after running the business, prudently investing for the future, doing all the things that a good management should do, this company over time has accumulated a cash balance of $2 billion. So their balance sheet has no debt, $2 billion in cash, the assets of the business, and the share price is such that the total market capitalization of this company is $10 billion. All right, so that's the backdrop. Now, if I were running this company and it were my private enterprise, I'd be very happy with that kind of capital structure. But if you're in the public markets, if you're actually a publicly traded company with that kind of balance sheet, that is a terrible balance sheet because it's only going to be attractive and useful to a hostile acquirer, basically. And let's think about why. So when a company wants to buy another company, what do they pay? Well, they buy all the shares up, right? So you have to pay the market capitalization of the company, plus some premium typically in order to, maybe you announce a buyout and you announce that I'm going to buy this company at $11 billion, something like that. Well, this particular company, remember, when you buy a company, you get the balance sheet. You get all the assets, all the liabilities. In this case, there are none. And you get the factory, the plant, whatever. And in addition, you get the cash that sits on the balance sheet. And so the purchase price, if you offer $11 billion, the purchase price to you is not $11 billion. It's actually $9 billion because you get the cash too, and you can net it against your purchase price. And so ironically, this company is all they did by saving up their cash is they made it available at the discretion or at the pleasure of an acquiring company. And nobody wants to do that, right? So across the 1980s, actually, this was a problem that happened throughout the decade. This is sort of the decade of the Predator's Ball, and a lot of the buyout firms got their start during this era. And it's because there were a lot of excessively capitalized companies that were doing, maybe not exactly in my example, but things along the lines of what I described in my simple example. They just made it easier for an acquirer to buy out the company, mine the balance sheet for cash, and basically subsidize their own acquisition. So you don't want to do that. You don't want to just sort of donate control of your company by having a strong balance sheet. So you want to keep your balance sheet strong, but not too strong. And so in a situation like this company, this example I'm giving, it would actually be a strategically very prudent decision to consistently buy back stock over time to whittle down that cash balance and enrich the current shareholders. Because your job is to be a fiduciary. As a manager of a company, you're supposed to be a fiduciary for current shareholders, not for some buyout firm that's going to take you out and maybe gut your company. So keep these kinds of things in mind. This is a sort of a strategic aspect of buybacks. It's important to think about, and it's a good reason to do them. So as always, I hope these videos help, and thanks for watching.